There is a moment that happens to thousands of Americans every single year. They have done everything right. They saved for decades. They built up a retirement account that looks impressive on paper. And then, the year they finally stop working, they sit down with a tax professional and they get hit with a number that makes their stomach drop. A number they never saw coming. A number that nobody warned them about. And in that moment, they realize that a significant chunk of the retirement money they spent 30 years building belongs to the IRS. This is not a fringe situation. This is not something that only happens to people who made bad decisions. This is happening right now to people who did everything their financial advisor told them to do. People who maxed out their 401k. People who followed the rules. And the reason it keeps happening is because of a set of tax traps buried deep inside the retirement system that most people never learn about until it is far too late to do anything about them. Today, on Wealth Vision, we are pulling back the curtain on the retirement tax traps that are quietly destroying the savings of millions of American seniors. And if you are within 10 or 15 years of retirement, or if you are already there, the next 12 minutes could genuinely save you tens of thousands of dollars. So stay with me, because this gets more alarming the deeper we go. And if you are new here, this channel is dedicated to giving you the financial information that the mainstream rarely talks about. Hit that subscribe button right now and turn on notifications, because the kind of content we cover here at Wealth Vision could be the difference between a comfortable retirement and a financially devastating one. We publish videos like this every week, and you do not want to miss them. Now, let us start with the trap that catches the most people. The one that almost everyone walks right into without realizing it. When you were younger and someone told you to put money into a traditional 401k or a traditional IRA, they probably said something like this. You get a tax deduction now, your money grows tax-free, and you only pay taxes when you take it out in retirement, when you will be in a lower tax bracket. That sounds perfectly logical, and for a long time, it was solid advice. But here's where things get dangerous. That advice assumes that future tax rates will be the same or lower than they are today. And right now, in 2025, that assumption is looking shakier than it has in a generation. The United States is carrying over $34 trillion in national debt. Social Security and Medicare are facing multi-trillion-dollar funding shortfalls. The Congressional Budget Office has projected that without major policy changes, federal deficits will continue growing for decades. What does that mean for you? It means the government is going to need more revenue. And one of the most politically convenient ways to raise revenue is to increase income tax rates. If tax rates are higher in 10 or 15 years than they are today, then every dollar you have sitting in a traditional 401k or IRA is going to be taxed at a higher rate than you planned. The tax deferral you thought was protecting you could end up costing you significantly more. But here is the part that most people never see coming. Even if tax rates stay exactly where they are, you could still end up in a higher bracket than you expect. And here's why. When you retire, most people think their income is going to drop. They stop working. No more salary. So naturally, they assume their taxes will go down too. But let us think about what actually happens when you retire. You start drawing Social Security. You start pulling from your 401k or IRA. Maybe you have a pension. Maybe you have rental income. Maybe you have investment dividends. And suddenly, all of those income streams are flowing in at the same time. And the IRS is watching every single one of them. Here is the number that shocks people. If you are a married couple and your combined income, including your Social Security, exceeds just $44,000 per year, up to 85% of your Social Security benefit becomes taxable. Think about that. You paid into Social Security your entire working life. You watched that deduction come out of every paycheck. And then, in retirement, the government can turn around and tax up to 85% of those benefits back. This is called the Social Security tax torpedo, and it hits millions of retirees who had no idea it was coming. Let us put real numbers on this. Say you are collecting $24,000 a year in Social Security, and you are pulling another $40,000 a year from your traditional IRA. On paper, that looks like $64,000 in it. But because of the way Social Security taxation works, the IRS effectively treats a portion of your 401k withdrawal as if it generates extra taxable income on top of what you already withdrew. Every additional dollar you pull from your IRA can cause more of your Social Security to become taxable. So that $40,000 withdrawal might generate more than $40,000 worth of taxable income. The math simply does not work the way most people think it does. That alone would be bad enough. But it gets worse. Starting at age 73, the IRS forces you to begin taking money out of your traditional 401k and IRA accounts whether you want to or not. These are called required minimum distributions, or RMDs. And the amount you are forced to withdraw is calculated based on your account balance and your life expectancy tables. Here is the trap. If you spent 30 or 40 years letting that account grow without touching it, the balance could be enormous. And enormous balances mean enormous RMDs. We are talking about forced withdrawals that could push you into a tax bracket you never anticipated, while simultaneously triggering the Social Security tax torpedo, while potentially causing your Medicare premiums to spike because of something called IRMDA, which we are going to talk about in just a moment. Let me show you exactly how this plays out with a real-world scenario, because the numbers are genuinely staggering. Imagine a couple, call them Robert and Linda. They both worked for 35 years. They were responsible. They maxed out their 401k contributions every year. By the time they retire at 65, they have $1.2 million sitting in their traditional retirement accounts. They feel great. They have done everything right. But here is what their financial advisor may not have clearly explained. At age 73, the IRS starts forcing them to take required minimum distributions. With a $1.2 million balance, their first RMD could be around $46,000. The income of roughly $36,000, and they are suddenly looking at over $80,000 in combined income. That means up to 85% of their Social Security is now taxable. That means they could be pushed into the 22% federal tax bracket, possibly higher depending on their state. And because their income has crossed certain thresholds, their Medicare Part B and Part D premiums have just jumped significantly due to IRMDA surcharges. A couple in that situation could easily be paying an extra $2,000 to $4,000 per year in Medicare premiums alone, just because their RMDs push their income above the threshold. Robert and Linda thought they were in great shape, and in many ways they are. But nobody sat down with them 15 years earlier and said, here is what this account is going to look like at 73, and here is what the IRS is going to do with it. Nobody showed them the full picture. And now, they are locked in. Most people never see this part coming. And that is exactly the point of today's video. Now, here is where things get interesting. Because once you understand the trap, you can see the way out. And the strategy that financial professionals are increasingly recommending is something called Roth conversion. This is the process of taking money out of your traditional IRA or 401k, paying the taxes on it now, and moving it into a Roth account where it will grow completely tax-free and never be subject to required minimum distributions. The window to do this effectively is typically in the years between when you retire and when you start collecting Social Security, or before your RMDs kick in. During that window, your income is often lower than it will be later, which means you are paying taxes at a lower rate than you might face down the road. You are essentially choosing to pay a smaller tax bill now instead of a larger one later. The math can be remarkable. If Robert and Linda had started Roth conversions at age 62, converting $30,000 to $40,000 per year for a decade, they could have dramatically reduced the balance in their traditional accounts. Their RMDs would have been much smaller. Their Social Security taxation would have been lower. Their Medicare premiums would have stayed in the standard range. And over a 20-year retirement, the total tax savings could easily exceed $100,000 or more. That is real money. That is the difference between leaving a meaningful inheritance and watching decades of savings slowly erode to the IRS. But here is what nobody is talking about loudly enough. The clock on this opportunity is not infinite. We are currently living in a period of relatively low historical tax rates. The Tax Cuts and Jobs Act of 2017 set rates that are scheduled to sunset at the end of 2025 unless Congress acts to extend them. If those provisions expire, tax rates could automatically increase across multiple brackets. That means the window for affordable Roth conversions could be closing. And if you are in your late 50s or early 60s and you have not had this conversation with a tax-aware financial planner, you may be running out of time to act before the landscape shifts. And there is another layer to this that almost nobody discusses: state taxes. Most financial conversations about retirement focus entirely on federal taxes. But depending on where you live, state taxes can be devastating. 9 states have no income tax at all: Florida, Texas, Nevada, Wyoming, Washington, Alaska, South Dakota, Tennessee, and New Hampshire. But the other 41 states do tax income, and many of them will happily take a bite out of your retirement withdrawals, your pension income, and even your Social Security in some cases. If you are living in California, your top state income tax rate reaches 13.3%. If you are in New Jersey or New York, you are dealing with rates that can climb well above 8%. Add that on top of federal taxes, and suddenly your effective marginal tax rate in retirement could be 30, 35, even 40% in some situations. Meanwhile, people who retired to Florida or Texas are keeping every dollar above the federal tax line. Over a 20-year retirement with $60,000 in annual withdrawals, the difference between retiring in a high-tax state versus a no-income tax state could easily represent $200,000 or more in lifetime tax savings. This is why retirement tax planning is not just about how you invest. It is about where you live, how you structure your withdrawals, which accounts you draw from first, and in what sequence. Every one of these decisions compounds over time into either a wealth-building outcome or a wealth destruction outcome. And then there is the Medicare trap, which is quietly becoming one of the most painful financial surprises in retirement. Most people assume Medicare costs a fixed amount. The standard Medicare Part B premium in 2025 is around $185 per month per person, which is roughly $4,400 per year for a couple. That is already a significant cost. But if your income exceeds certain thresholds, the government charges you significantly more through the Income-Related Monthly Adjustment Amount, known as IRMA. For a married couple with income above $212,000, the Medicare Part B premium jumps dramatically. We are talking about an extra $3,000 to over $7,000 per year above the standard premium, depending on exactly where your income falls. And here is the insidious part. These income thresholds are based on your tax return from 2 years ago. So if you had a high-income year because of a large Roth conversion or a property sale or an unexpected windfall, you could find yourself paying IRMA surcharges for a full year with very little warning and very little recourse. Robert and Linda from our earlier scenario, if their combined income, including RMDs, pushes them past that threshold, they could easily pay an extra $3,500 to $5,000 per year in Medicare premiums on top of everything else. That is another $300 to $400 disappearing every single month. And over a 15 to 20-year retirement, that becomes a 5 to 8-figure mistake that traces back to decisions made, or not made, decades earlier. This is the retirement tax system that millions of Americans are walking into right now. Not because they were careless, not because they were uninformed, but because the complexity of this system is almost by design. The rules are scattered across different agencies and different tax codes and different enrollment deadlines. And the people who understand all of it tend to be expensive specialists that most families do not consult until they are already retired and the damage is already done. So what do you actually do with all of this? First, if you are still working and you have access to a Roth 401k option, take it seriously. Pay the taxes now on your contributions while your marginal rate is known, and let that money grow completely tax-free. Many employers offer both traditional and Roth options within the same 401k, and most employees never even look at the Roth column. Second, if you are in your late 50s or early 60s, have a specific conversation with a fee-only financial planner about Roth conversion strategy. Not just a general conversation. Ask them to model out your projected RMDs at age 73, show you what your Social Security taxation will look like, calculate your projected IRMA exposure, and compare that against the cost of strategic Roth conversions right now. This is a math problem with a real answer, and most families have never had it solved for them. Third, think hard about sequencing your retirement income. Many retirees default to drawing down their taxable investment accounts first and leaving their IRAs alone to grow. But depending on your situation, drawing down the IRA first in lower income years or strategically converting portions to Roth could save you significant money over the long run. There is no universal right answer, but there is definitely a right answer for your specific situation, and it is worth finding out what it is. And fourth, if you have not thought about the state you plan to spend your retirement in, now is the time. A move to a no-income tax state is not right for everyone. Family, healthcare, cost of living, climate, and quality of life all matter enormously. But the tax difference is real, and it is large, and it deserves to be part of the conversation. Here is the deepest takeaway from everything we have covered today. The retirement system in America rewards people who understand its complexity and punishes people who do not. That is not fair, but it is the reality. The people who retire comfortably and keep most of what they saved are not necessarily the people who earn the most or save the most. They are often the people who were most intentional about where their money sat, how it was taxed, and in what sequence it was deployed. Taxes are not a fixed cost in retirement. They are a variable that you can influence. And the earlier you start influencing them, the better your outcome. The clock is ticking on several fronts simultaneously. Tax laws are uncertain. RMD rules are locked in by your account balances right now. Medicare thresholds adjust regularly. And the longer you wait to plan around these traps, the fewer options you have. If this video opened your eyes to something you had not fully considered before, I want to hear from you in the comments below. Are you already thinking about Roth conversions? Have you run the numbers on your projected RMDs? Are you worried about the Medicare trap? Or maybe you are already living through one of these situations right now. Whatever your story is, drop it in the comments. This community learns from each other, and every perspective adds value. If this video was useful to you, please take a second to hit the like button. It genuinely helps this channel reach more people who need to hear this information. Share it with someone you know who is approaching retirement, because the earlier they hear this, the better their outcome can be. And if you are not subscribed yet, click subscribe and turn on notifications so you never miss a video like this one. Coming up next, we are going even deeper into something that directly connects to everything we covered today. The next video is called Why Your IRA Could Become Your Biggest Tax Problem. And trust me, if what you heard today surprised you, what is coming next will genuinely change the way you think about that retirement account you have been building for decades. The IRA was sold to you as a gift, but for millions of